So today's cardinal lesson, we've got the tax brackets up here for single people and for married filing jointly. And so what are we talking today? We're talking about the sunset of the Tax Cuts and Jobs Act, which went in and has affected your 2018 tax return. You got a tax cut, and you enjoyed that in 2018, 2019, 2020, and now we're in 2021, and you could say that if your taxes have been cut, you're enjoying it the rest of this year. And there's a lot of talk about tax increases, capital gains, estate taxes, and a lot of it is just talk, because if you'll remember, with this Tax Cuts and Jobs Act that got us to where we are now, it took a lot to get all the people to come together to sign on to this thing. Just the percentages of people you need. But anyhow, it got passed, it got started, and we've been living it for a few years. And now a lot of people say, well, taxes are going up. Well, maybe, and they probably are. But what I'm going to tell you is for sure, baked into the law, they're going up in 2026. I mean, just so if you fit in this bracket right here, they were 15%, they got cut to 12%. If you're in this bracket, they were 25%, they got cut to 22%. If you were in the 28% bracket, you got a cut to 24%. And it's baked into the law that on January 1st, 2026, again, if they don't change it, the numbers in red here are going to be your tax rates. So what does that mean? That means that I got 2021, 2022, 23, 24, and 25. Now, I'm pretty confident these are going to be the tax rates for all of 2021. And I'm starting to get confident these are going to be your tax rates in 2022 as well, because I just think the odds of them all coming together and getting the bipartisan majorities that they need to do anything with taxes is pretty slim. And every year that goes by, you're on this rate and this rate and this rate, or wherever you fall in the spectrum. And in 2026, we're getting a tax hike, unless they're successful in changing it, okay, which that may happen by then. But we can only plan with what we know now. And say, well, why does that matter? Why are you raising? Most of our clients are people in their 50s and 60s and 70s that are coming into us for financial planning. We're helping them with Medicare and long-term care and income planning, tax planning, estate planning, and we're just helping them get their whole thing together and organized so they can have they can finish well, they can have a great retirement. And tax planning, looking forward, is just an important part of what we do, and it's very important to our clients like you. And so why does this matter that I've got 1, 2, 3, 4, 5 years if I fall into, kind of this bracket of income? Why does it matter to you now as a client, or why does it matter to me as a financial planner helping you? Is every year that passes, you lose the opportunity to convert some of your IRA money or 401k money from a traditional side to the Roth side. So I'm talking about Roth conversions. So, one of the bad things about a Roth conversion is you got to pay the taxes now. And a lot of people say, well, why would I pay it now when I can wait to pay it in the future? Well, for starters, when you're withdrawing money out of that traditional, it's going to be at higher rates, maybe much higher rates if they raise taxes like they're talking about doing. But we can only plan around what we know for sure. And so I'm just going to give you an example. Let's say we have a couple. I have a lot of couples that fit in this 81,051 to 172,750 tax bracket. And maybe one of them's working, maybe two of them's working, maybe they're retired, but they're just retiring, whatever. I have a lot of people in this bracket, and they're paying, or we'll talk about single people in a second. So they're at the 22% tax bracket. Now, a lot of them just don't realize how low that is historically. I mean, I've been doing this business 45 years and looking at these numbers and helping people. And, a 22% federal tax bracket is low. Okay, well, thank you. I mean, so you're able to keep more of your money. But when you retire, you're going to be living off of Social Security and, if you're like a lot of folks, withdrawals from your 401k IRA. Okay, and that's a whole other section of what we do, is planning those withdrawals. But those withdrawals are going to create your taxable income. And if they're on the traditional side, if you have to pull a lot of money out of there, your tax rates are going to go way up. So there's this thing called a Roth IRA, which at Roth is tax-free. Not tax-deferred, but it is tax-free. And what that means is you've already paid tax on the principal that's in there, and you're never going to pay tax on the earnings in there. So the whole thing is tax-free. You can pull money out of there at will, and then in retirement, that's a pretty sweet thing to have a pot of money that's in a Roth IRA. And if you've already accumulated your money, you're in your 50s and 60s, and most of the things done, then what you do coming into us is we sit down and talk about a Roth conversion. And we're going to get out this chart, and we're going to figure out whether you're married or single, and we're going to see where you are tax-wise right now with the income you're living off of. And then we're just going to go up to the next bracket. So if I take this couple that's in this category right now, 81 to 172, and they're paying 22% only on their money over 81, well, the one thing I know I can do is I can convert some of their Roth up to 172, and I can also convert up to 329 and still only pay 24% income tax on that converted portion. Now, there's going to be state income taxes too, so depending on what state you live in, we study those all the time, and we're going to put those into your calculation when you decide whether you're going to do this or not. My only point is you got 5 years left if you count this current year. If you're watching this video in 2021, if it's a year from now, it'll be less than that, but you got 21, 22, 23, 24, and 25, and then the tax rate is going from this to this, and this to this, and that's if they don't raise it. So it's like, Roth conversions are a little bit on sale right now for the next few years. And this is real painful to a lot of clients to sit down and, they're kind of saying, are you telling me that after I hired you to do this financial plan, you're coming back to me and you're going to raise my tax bill this year? I tell them that's exactly what I'm telling you. You can pay me now or you can pay me later. And this is a big problem, is accumulated IRA money for people in their 70s and 80s. Okay, they have a whole bunch of money. They've avoided the tax all those years, and Uncle Sam is going to get his money. I mean, it's coming. And a lot of people die with big balances in their IRAs. They pass them on to their children, and their children, if they need access to the money, they pay huge taxes on it because it throws them for that 1 year into like a higher bracket. So it's not a pretty picture to just leave a big bundle of money accumulated in a traditional IRA, and for you or for your heirs or your surviving spouse. So I'm a big fan of at least considering a Roth conversion, and if you do that, we're going to do that with these tax brackets in mind. We're also going to do it within the sense of how these tax rates are going up, and that just doesn't look that much, 22 to 25, but you run the numbers and you calculate it. I also, just pointed out, I have married one of my compadres doing this video, was just looking at this and said, the difference between these single rates and married filing jointly is huge. So I have a lot of people that are single that come in that are, somewhere in these zones for a single person in their 60s, getting ready for retirement or just retired. And now the numbers become tighter, but it's the same drill, is they can convert some of their IRA. You don't have to convert all of it. And if you convert a good bit of it, you're going to want to spread this over several years so you don't all of a sudden jump up in these brackets in any given year. So it's not too much more complicated than that. I'm Hans Scheil, and I thank you for listening.